This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, the day after that Fed decision, we're still talking about it, and that's going to be a focal point this hour. Very good afternoon, everybody. Carol Massar, Tim Stenovec, live here at Bloomberg headquarters in New York City. We've got markets up, and we're actually talking records?
Yeah, we're talking records, at least earlier in the session for the S&P 500 and the Dow. The NASDAQ, though, down half a percentage point. We have 363 stocks moving higher, 138 moving lower, but Oracle's a big story, and we're going to be talking about that in just a few minutes.
We are indeed. We're going to get into that AI spend and what it means in terms of debt and balance sheets, especially when it comes to Oracle. We mentioned it's the day after the Fed decision, so we're going to talk rates, policy reset. Katy Kaminski at AlphaSimplex, along with our own Mike McKee, back from questioning the Fed chair yesterday down in D.C., so they're both going to be with us. So we're going to roundtable a lot of stuff about what's coming maybe in 2026.
Plus, the House of Mouse, Disney dipping into AI.
Does Mickey and Minnie know? Does Goofy know? Hey.
You know they're not real.
Just saying. What?
They're not, yeah. I learned this recently.
Don't even touch Santa.
They're just characters. Even if you go to
Santa's
Disney
real
World.
too, you know.
Oh, well, I'm not touching that.
Elf on the Shelf, whole other thing. Hey, waxing and waning of companies in the GLP-1 race. Man, AI's been such a theme over the last few years. So has the GLP-1 drugs. But sometimes you're a winner, sometimes you're not. So we're going to get into some news today and who seems to be outperforming who or whom is it. We're going to get into that later on this hour.
And you mentioned AI spend, Carol.
Yeah.
We're going to talk Oracle in just a few minutes, and those credit default swaps.
All right, lots to come, so do not go anywhere. It's a busy Thursday. First up, though, let's get to that trade on this Thursday. Stocks definitely hovering near their best levels of the session. Let's turn things over to Charlie Pellet.
All right, I think very much indeed Oracle, absolutely the big story right now. Oracle shares, they're plunging 11.3%. Our coverage will continue right here on Bloomberg Businessweek Daily. We have got the Dow, the S&P, they are both higher right now. 68.93 is where we stand on the S&P. Yes, that is a record right now, up by about 0.1%. Dow Industrials up 619, higher by 1.3%. The Nasdaq Composite Index, so lower, down 105, drop there of 0.5%. Nasdaq 100 Index down 0.6%. Oracle again lower by 11.2%. The 10-year at 4.12% with a 2-year that's currently yielding 3.51%. Gold up $35 the ounce, 42.64, up 0.8%. West Texas Intermediate crude down 1.8%, 57.41 a barrel, and Bitcoin now down $1,500 per token, 90,908 right now on Bitcoin, lower by 1.6%. Oracle lower after the company reported a jump in spending on AI data centers and other equipment, rising outlays that are taking longer to translate into cloud revenue than investors want. So again, Oracle plunging 11.2%. NVIDIA, another AI bellwether, down now by 2.1%. Bottom line, buyers emerging, at least for the S&P, up 0.1%. Nasdaq, though, lower by 0.4%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, along with Tim Stenovec, live here in our Bloomberg headquarters studio. In the meantime, one of the stocks we are definitely watching today is Oracle. Kind of freaking out investors once again today, Tim. Shares plunging by the most since January, erasing more than $100 billion in market value after the company escalated its spending on AI data centers and other equipment, rising outlays that are taking longer to translate into cloud revenue than investors want. Show me the money, show me the return on investment to some extent.
What's cool about a company such as this is it's one of those companies that you can go back quite a bit in history. Like Cisco, for example. They were around back when. So at one point intraday today, the stock posted its steepest one-day drop since 2002. Also, the stock now down more than 40%. That was back on September 10th, the last time it reported earnings. That's when there was a report that Oracle and OpenAI signed a deal, and after the company gave an aggressive outlook for its cloud business, it cemented its place then in the race to support demand for AI computing. All of that then pushed the stock to a record high, but that was 3 months ago.
Yeah. Show me the money today is basically what you're talking about. Let's get more to it because we're looking at the balance sheet in a big way.
I want to bring in Robert Schiffman. He's Bloomberg Intelligence Senior Technology Credit Analyst. He joins us here in the Bloomberg Businessweek studio. So what are we missing? Because there's a massive backlog here, and that's what investors wanted to see. That signals demand. But why are we seeing so much? And look, I know we're going to talk about credit, but why are we seeing so much concern from investors today?
Well, it's the holiday season, and the market is deciding on who they think is naughty and nice. And clearly we know where Oracle is shaping out right now. And quite frankly, I think it's overdone. I think that this whole concept of panic and bubble and financial crisis and CDS concerns really doesn't take into account the bigger picture of where this company is. So what is the market really worried about right now? So Oracle's growth last night came in a little bit slower than the equity community had hoped for. I think if this was a Microsoft or an Alphabet or an Amazon and they missed cloud growth by 1 or 2%, you'd see similar moves. So what else is really differentiating Oracle? Well, the difference for Oracle is that they've got the most amount of debt out of any non-financial issuer in the high-grade corporate market. They've got $100 billion of debt. And they're spending a lot. And quite frankly, they're spending even more than the market anticipated. They said last night, we're going to spend $15 billion more in CapEx this fiscal year than what we had guided. So they need to borrow a lot of money. They already have a lot of debt. There's a tremendous amount of hedging that's going on that's pushing CDS wider. And quite frankly, it's just a simple story. You need to spend money to make money. You have to spend a lot of money up front before you start collecting that cash. And it's just going to take a little bit of a little while for those revenues and cash flows to catch up to the amount of debt that they have.
So tell everybody, take a chill pill, basically, right? That you think the spending makes sense, and it's just a case of time for it to pay off.
Yeah. So listen, I'm a credit guy, but let's look at the stock for a second.
But credit can tell us so much.
Let's start with the stock. The stock is way off the highs, right? When they announced all these contracts. Going above $400 billion, the stock shot up. And now we're down more than 40% from the highs. But if we just go back to the beginning of the year, we're still up by 20%, right? This is a $500+ billion market cap company. There's not a reason to panic about that. They've issued a lot of debt. They issued an $18 billion bond deal. There's been discussions about them doing some sort of private deals to fund data centers upwards of $38 billion. That number, quite frankly, might be a lot higher. That could be $50 or $60 billion. And there's reasons behind that, because you can do a lot of this through SPVs, do it off balance sheet, and protect your ratings. Oracle was very clear last night. They said it without being asked. We are committed to our investment grade ratings. It makes sense. They should be, because you don't want to have a balance sheet that has $100+ billion of debt that you have to finance in the junk market. But I think what it means is there's a lot of different triggers for them to pull in order to protect their balance sheet. And to eventually get spreads tighter. Now, we just have to recognize, though, in the very short term, the risks probably do outweigh the reward. You have rating agencies.
How do we know that for sure? Because of the demand and the backlog? Is that what that tells us?
Yeah, well, listen, they added to their backlog by a significant amount. Now they have well over $500 billion of signed contracts. We could debate whether or not they're actually ever going to get paid for that. And I think the market is doing that.
Well, is that the concern?
Well, that is the big concern, that OpenAI, which might be their biggest customer, might not have enough money themselves to pay for what Oracle is building. I think Oracle is starting to try to lay out, if they come, we'll build it. There's a way that you don't have to put all the capital up front. Again, there's a lot of ways to do this from a financing standpoint. A whole rent-a-chip philosophy where they're not actually buying chips, say, from NVIDIA.
But does the creative financing just maybe potentially, Robert, just mask, there's still a spend, there's still an expectation. So even if you're creative in terms of how you finance, aren't you still potentially vulnerable if this doesn't all come to fruition?
Well, they're not going out.
Or takes longer?
They're not using the money and buying Christmas and Hanukkah gifts for their employees. They're building assets that are going to generate these revenues and cash flow. It's part of any business build. You're not seeing these same sort of questions in the credit markets about those other big hyperscalers. You're only seeing it for Oracle because they're mid-BBB and people are worried they're going to fall to junk.
So just 20 seconds, what would concern you? What piece of information would come out from the company that you would say, okay, now I actually am concerned about this?
Well, the two concerns would be the rating agencies downgrade to low BBB and keep the outlook negative and give some sort of numbers that might not be achievable. And two is when Oracle comes back in 3 months or 6 months, and we don't see the type of growth that we're anticipating from their cloud and infrastructure businesses.
So every quarter we get a check.
You got to check every quarter.
All right, good stuff. So appreciate it. Robert Schiffman, he's Senior Technology Credit Analyst at Bloomberg Intelligence right here in our studio.
Everybody should do it. They should sign up for his newsletters because... I
love it.
Yeah, you learn a lot. So do that on the Bloomberg terminal. Can they just send you an email for that?
Can IB me or MSG anytime?
Okay. We'll do that. All right, that is our Oracle post-mortem. Of course, we did get their earnings after the close yesterday. Now let's get to our Fed post-mortem. It is the day after the Fed's third consecutive rate cut, the third consecutive meeting, too, where the U.S. Central Bank talked about risks to both sides of its dual mandate. It's a tough spot to be in for sure. So let's get to our roundtable. But before we do that, we did have a really smart voice weighing in on the Fed's moves. We're talking about Oaktree Capital Management co-founder Howard Marks, who joined the surveillance team this morning on radio and TV. He warned of little merit in further Fed rate cuts. He spoke with Bloomberg's Lisa Abramowitz.
I believe that the Fed should be passive most of the time and only come to the rescue if the market is, if the economy is seriously overheated and tending towards hyperinflation, or seriously underactive and not creating jobs.
All right, that is Oaktree Capital Management co-founder Howard Marks earlier on Bloomberg Surveillance. I do also want to just add, he said the Fed's manipulations around the cost of money will drive people into riskier investments as the return environment moderates. So let's get to our panel.
We've got Katy Kaminski with us. She's Chief Research Strategist and Portfolio Manager at AlphaSimplex Group. She joins us from Boston this afternoon. Also here, a Bloomberg TV and Radio International Economics and Policy Correspondent Michael McKee. He's in the Bloomberg Businessweek studio. Mike, yesterday, 24 hours ago, you were down in Washington, D.C. You were asking Fed Chair Jay Powell questions. You were in the room where it all happened. What struck you about the decision? And then also his later comments on everything from the Fed's challenge dual mandate, AI, the next Fed chair, and much more.
Well, I loved Carol called it a post-mortem, like everybody's dead now.
Sorry.
The economy's dead too.
We're still here.
We're still here. Well, there are a number of different things that are at play there because the markets expected the cut and the markets expected some dissents, and we got both, and people are complaining because they didn't get enough dissents or whatever. I think the bottom line is that the Fed is telling us we really don't know what's going on, and there are some people, half of them think that the inflation's the biggest problem, and half of them think that the job market's the biggest problem, and so they're divided on that. They all have the same goal in mind of a healthy economy, but how to get there is what they're divided on. And we're also talking about a 25 basis point cut, not a huge amount. So I think we maybe make too much of all this stuff. If you're going to look at the dissents, then what it's telling you, and remember there were 4 people who basically did a soft dissent, said that they didn't want to cut rates even though they weren't voters. So what it's telling you is it's going to be hard for any Fed chair to come in and immediately get people to lower interest rates dramatically, because a lot of people don't want to do that right now. But beyond that, I think you just have to take it at face value and say this meeting has a short shelf life. Fed doesn't know what's going on with jobs for certain and with inflation for certain. But starting next week, we're going to get this big data dump. And then we go into the new year with tax refunds. We go into the new year with a new Fed chair. We go into the new year with Trump chaos going on.
Yeah.
And so you can't really make anything out of these predictions because it's all going to change.
All right. So just forget it. Everything, everybody, move into 2026. Hey, Katy, come on in. Most significant thing for you in terms of what we got from the Fed and the decision, and then what we heard from Fed Chair Jay Powell.
I would say I would have to agree that, it's only a 25 basis point cut. There's definitely still some uncertainty across, but there was generally a positive tone. I think people were afraid that there would be a little bit of a stronger tone, a little more hawkish, but I think the market seemed pretty satisfied with this move. You've seen the US dollar weaken pretty substantially post the meeting. You've also seen yields down, and you've seen sort of market moves in consensus of that meeting. So I'd say that, there is still a lot of uncertainty, but we're definitely only talking about a 25 basis point cut.
Katy, which do you think is more important for the Fed to address right now? I mean, as Mike mentioned, they're pretty much split on which is the important part of their dual mandate right now. What's more important and needs to be addressed quicker?
Well, clearly, because they're leaning a little in the labor market data, I think that the Fed has definitely grasped onto that, and that's why they're making this decision to cut. But I think, it is interesting for us right now that are trading some of the international markets. You have seen very different moves in places like Australia, where inflation has ticked up. So I think why there's a lot of uncertainty is, there can be different cycles of inflation. And I think that's what we're going to be talking about next year. And that's why people are still very concerned about inflation as an important input for the mandate of the Fed.
Hey guys, I want to ask you if Howard Marks had a point, speaking with Lisa Abramowitz this morning, saying that basically little merit in further Fed rate cuts. I mean, Mike, your thoughts in terms of the economy. You even, I think, posed the question, or I'm trying to think where you said it, maybe with the TV colleagues yesterday, of like growth was raised up in terms of the estimates. Inflation seemed to be maybe not more of a worry. Like, why did the Fed even need to cut rates yesterday?
Well, they portrayed as insurance because they're not sure what is actually happening, and they're worried. The majority were worried that the unemployment rate would keep going up, and unemployment does have a history of, if it starts going up, it can go up very rapidly, and that's what they want to forestall. But we've come down now 150 basis points over the last 2 years, and so we're, even as Jay Powell admitted, we're getting very close now to the neutral rate. He thinks we're at the, sort of the top of the range of the neutral rate. Others would say we're already very close to the neutral rate. So whatever moves are going to come, there probably won't be much more. So this is a logical time to stop it and look around as well. Now, the SEP that they put out didn't really hang together, because if you're going to have a major boost in growth, it's not going to send inflation lower, especially when you're cutting rates. But again, I think this is just all kind of a filler for the time being, and it didn't have to make sense because they know it's going to change.
Yeah.
Hey, before we let you go, Katy, the comments that the Fed chair made yesterday about AI and productivity, he was asked about, that was really fascinating to me. And I'm just wondering, in terms of not back of the envelope, but like the real calculation that you see when it comes to the AI effect right now on productivity, what is it? Just 30 seconds.
Well, I mean, I think you're seeing productivity estimates up significantly, and everyone is feeling the effects of that productivity. So I think we're going to keep watching that narrative and need to really quantify it more going forward to understand its real impact on GDP.
Hey, Katy, I'm going to save you 20 seconds to ask you, is 5% on a 10-year more likely, or is 3.5% more likely on a 10-year?
I'd have to say it depends on the time horizon. If we have lots of rate cuts that are kind of against the general consensus, I think you could have a steepening of the yield curve, but I think it's more likely that we're going to status quo and be closer to 3.5.
All right. Interesting stuff. Hey, guys, thank you so much. Better or worse, it was a postmortem as we continue to work our way through. Nobody got hurt yet. Katy Kaminski, Chief Research Strategist, Portfolio Manager over at AlphaSimplex Group in Boston. And of course, right here in studio, Bloomberg TV and Radio, International Economics and Policy Correspondent Michael McKee. When we come back, some stories and stocks on our radar. That's next.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P. They are both advancing. Could see record closes there. We've got NASDAQ in the red. NASDAQ Composite Index right now down 72. Drop there of 0.3%. NASDAQ 100 Index down 115. Drop there of 0.4%. S&P up 0.1. The Dow surging by 1.3%. But caution toward AI heavyweights persists with NVIDIA down, Bitcoin falling, and Oracle is plunging. Right now, we've got Oracle shares down 10.1% after earnings. The 10-year yield 4.14%, the 2-year 3.52%. Spot gold up $43 the ounce, now up 1%, $42.72. West Texas Intermediate crude 57.61 a barrel, down 1.5%. Bitcoin down 1.4%, $91,100 on Bitcoin. Briefly, Rivian Automotive says it has developed its own AI chip replacing NVIDIA technology as part of a broader push to add and enhance automated driving features in future vehicles. With Rivian shares, they're down 8%. NVIDIA right now tumbling by 1.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stenovec, live here at Bloomberg headquarters on Bloomberg Businessweek Daily. Hey, we have a few stocks on our radar, really in the media and related space, if you will. One is on the Magic Kingdom's move into AI, and then, of course, it's the ongoing, not yet ending pursuit of Warner Brothers Discovery. Yes, it goes on. Covering it all, Bloomberg News media reporter Hannah Miller. She's right here in studio. Hey, let's talk. Hannah, we've been talking to you a lot. There's a lot going on. Disney shares a little bit higher. This on news that the company agreed to invest $1 billion in OpenAI and license iconic characters. What do we know about this deal?
Yeah, so we know that it's a big deal.
It does feel like a big deal.
This is really exciting. There's been a lot of tension in Hollywood over the use of AI for film, for animation, things like that. And Disney has made a huge statement here with this investment. And yeah, it's concerning, there are a whole suite of characters, we've got Marvel, Pixar, Star Wars. You can use that with OpenAI's Sora app and kind of create, these short, social media friendly videos using these characters without fear.
What if they have like Mickey as like a slasher dude or something? Like, are they okay with
people
that?
Could write that. People could draw that anyway. I mean, that stuff happens anyway.
But there's somebody who's so protective of their IP. Like, you and I have been trying to figure this out.
I think you make a really good point, because if you remember back to the early days of like image generation in the last 3 years, when people were really experimenting with these LLMs and getting them to do stuff, they were actually creating characters that were, Disney would never actually create, or other IP owners would never actually create, and everyone was like, wait a second, this is going to be a huge headache for these companies.
Yeah, so we know from the beginning, like you said, people have been drawn to this. They've been doing, their own creative stuff with these characters. Some of it is fun, some of it is not. So, I'd have to imagine that there's, maybe restrictions here with how people use this app. Like, you can put parameters in with these models.
So maybe, okay. The other thing that I think of is just Hollywood's relationship with AI. And when we were at Screen Time earlier this year, a big conversation that we had back in October was about, what is, and this was the whole writer's strike too, and the actor's strike in the last couple of years. This is what was the core tension, right? To what extent are these studios going to use AI from a scripts perspective, from an actual visual effects perspective, to replace us, to supplement us? Does this send a signal about how Disney views this technology to the creative class?
Yeah, I think Bob Iger here, he's going to have to convey a sense of reassurance, to the people working under him. Even though this is a first step forward, I just want to point out you can't use voice with any of these characters. You can't use like Tom Hanks's voice for Woody from Toy Story, for example. But it is still a huge development. And I know a lot of creatives in Hollywood are worried that, they could be replaced.
Why? What?
Go ahead.
Why is Disney doing this?
Yeah.
Is it just, have they done anything internally when it comes to AI on their own? Or like, why are they doing this?
They've filed a lawsuit against Midjourney.
That's the company I was thinking of, yes.
Yeah. So, that was sort of the earlier sentiment that they had.
Yeah.
But, I think what we can see here is they want a piece of the AI pie. That they don't want to be left out or left behind. And this is a way to build a partnership.
With the prom queen, right?
Yes.
Basically, OpenAI. Everybody's just making sure they have some kind of relationship with OpenAI.
Yes.
But apart from, and I think to Carol's point also, apart from the equity investment in OpenAI and getting a piece of that financial upside, if there is financial upside, I mean, look, it's still a privately held company. There's a lot of questions about, and even Sam Altman's concerned about OpenAI right now, and there's a lot of competitors. So apart from the financial upside, what else does Disney get by doing this?
You know, they get the lead. And they're ahead of other entertainment companies. They're embracing AI. They also, you know, they get some pluses too, like their employees now have access to ChatGPT, other enterprise tools. So I think they're looking at this from a, you know.
But from a branding perspective, is it like, okay, let's say my kid loves Toy Story and I can use then ChatGPT to create some sort of cool, I don't know, birthday party invitations for him and his friends for their birthday. Does Disney see that as, okay, well, this is a good use of our brand, an extension that then gets this kid more interested in Toy Story and then going to Disney in California or Florida? Is that the idea?
I think you hit on a great point here that, you know, they're already establishing brand recognition in a new way. You know, I mean, everybody knows Disney, but this is just yet another avenue to get people on board and show that they're a tech-forward company, that they're willing to embrace the future and they're not going to be left behind.
I love what Sam Altman apparently said, right, in an interview with CNBC, that demand for Disney characters is off the charts. Like, so he understands that this is an important part.
Love Disney.
Who doesn't love Mickey and Minnie or Donald?
Well,
or
you think of it as a thing for kids.
Any of them.
But it turns out a lot of adults love Disney.
Yeah, I used to know someone kind of growing up who used to love to draw the Disney characters. It was an adult, it wasn't a kid. And investors are, you know, rewarding the company today. So it's interesting. All right.
Well, Disney's focusing on AI. Other companies are focused on, wait, how much is this company going to cost me that I'm going to buy?
Can we get the deal done? Can I stop paying bankers and just sign on the dotted line? We're talking Warner Brothers Discovery. Where are we?
Yeah, so we're waiting right now. You know, Warner Brothers has 10 days to respond to that, you know, hostile takeover bid from Paramount.
So 10 days from Monday?
Monday, and it's 10 business days. They could come back sooner. You know, we could see something as early, you know, as next week. And, you know, they are waiting to see what Warner Brothers says, whether there's going to be a rejection or, you know, maybe they want more information. And, you know, if they still decide to go with Netflix, Paramount has some options here. You know, I mean, there's been a lot of industry talk about whether or not they'll sue. You know, David Ellison has already talked about some frustrations with the bidding process. And there's a shareholder vote on January 8th. So we'll be tracking until then.
Our understanding, too, is Bob Iger also said this morning in comments that he hasn't determined yet if he'll take a position on Warner Brothers. So wait, is this still, like Comcast has kind of said we're out, right? We've heard that. But is it possible that Disney somewhere comes in?
You know, I mean, I think the race is really tight here already. I mean,
Why would he say that?
You know, I think a lot of...
I get his competitors to pay more.
Yeah.
Kind of playing around with them?
Yeah, I don't know. I'm not saying that's why he would do it, but if I were in his position, I would want my competitors to pay as much for other things as possible.
Like make it tough.
Yeah. Say, hey, maybe we're sniffing around a little bit, maybe increase that price.
Yeah. And you know, we know Paramount, you know, they've left it open to an increase, so we could see that down the line.
So what about CNN's fate? Because late yesterday, Carol and I were here in the studio, and a headline crossed the Bloomberg terminal. The president essentially saying it should be guaranteed that CNN is part of it or sold separately. This is the president said, any deal for Warner Brothers should include the sale of its CNN cable network. So does that mean that if Paramount Skydance were to win the bid, they would have to shed CNN?
So the thing that President Trump emphasized is he wants to see CNN under new leadership than it currently has.
Okay.
So that doesn't look as good for the Netflix deal because Netflix only wants the streaming and studios business.
Yeah.
Warner Brothers will then continue with the spinoff of its cable networks, including CNN, and it'll be a separate company called Discovery Global. But it'll still have, you know, the same people at CNN.
Existing leadership will stay.
Yeah. So that's why that doesn't look as good.
So this is about him wanting new people in charge.
Exactly. So it's like, I think a lot of people in the industry interpreted that as better for Paramount.
Can I ask you something in terms of what we've been talking about, certainly on our planning calls and as a show unit, just what's happening in media And with these deals and ownership and the president's say in this, and now we're talking a lot more traditional, whether it's kind of the old-fashioned TV networks, forgive me, or some of the cable guys that have been around for a while, the all-newsers. Are we seeing kind of a shift to more conservative leadership and perhaps conservative programming?
Yeah, you know, we've already seen changes at CBS, which is owned by Paramount. And David Ellison has come in, made significant leadership changes there by appointing Barry Weiss, who founder of the Free Press, as the head of CBS News. And there's been a lot of talk about how that will affect programming. You know, we're still kind of seeing those changes shake out.
Yeah.
But yeah, there has been a lot of talk of, you know, whether Paramount will do similar things with CNN, you know, whether certain anchors will be out. And, you know, there's already just been multiple attacks on CNN from the right.
Yeah, look, I think a lot is still unknown because we don't know who's going to actually ultimately win this deal. Carol mentioned Disney potentially coming in because of the comments that Bob Iger made earlier today. But I'm wondering if you think there are any other parties that we should be watching, or if this is all coming down to just these two companies, Netflix and Paramount Skydance.
We're keeping our attention right now on Paramount and Netflix. That's where we're, you know, seeing the action and how that's going to play out. But you know, I can't see the future.
Well, Bernstein weighing in, an analyst there, Lauren Yoon, saying Netflix needs to make sure it has an exit strategy in case the bidding war for Warner Brothers, quote, unquote, turns irrational. So, I mean, right, like if you continue, there's a point where maybe then the price doesn't make so much sense, but you do wonder about strategy, how important this is for Netflix.
Netflix shareholders don't love this. I mean, I don't remember the stat yesterday. I think it was 16% in 6 days that Netflix was down. This is its first up session in 6 days. It's down. Look, if you look at June 30th, it's high of $133 a share. Now it's trading at $94 a share. Does that make Netflix think twice that shareholders are not loving this?
Yeah, I mean, we know both parties are going to be tracking the market closely. Warner Brothers is looking at market reaction as well, I'm sure.
Yeah.
With Netflix, I mean, this is a big reversal for them. And they've talked about how they're more of a builder than a buyer. And this is a huge, huge change. There's also a lot of anxiety in Hollywood about this deal and, you know, concerns that, you know, with Netflix emphasizing streaming and considering the theater experience may be outdated, that this would hurt film production and theater attendance.
Yeah, it's kind of fascinating. Our story here, though, about this Bernstein analyst, stock has already lost more than $100 billion in value since it reported earnings in October. So Netflix, I mean, investors certainly weighing in and voting pretty clearly on what they think, you know, what they feel about this move by Netflix. I am sure we will be talking to you again. Hannah, thank you so much. Really appreciate all this reporting as we continue to watch this play out. Hannah Miller, media reporter at Bloomberg News, right here in our New York studio. All right, folks, quick check on the trade for you. We are hovering near our highs of this session. We are up about 0.2% on the S&P 500. We've got the Dow up about 1.3%, and Tim, the Nasdaq 100 just down about 0.4%, but at its highs of the session.
Okay, coming up next, why the Fed is well positioned to wait and see. That's from our next guest. This is Bloomberg.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the S&P 500 index advancing. Could see a record close. Right now it's 68.99. The old high 68.90 right now. Dow Industrials up 643 at 48,700 even, up 1.3%. Nasdaq though in the red. We've got Nasdaq down 62, a decline there of 0.3%. The Nasdaq 100 index down 0.4%, and the Russell 2000 index of small cap shares up right now by 1.3%. Bottom line here, buyers are emerging for U.S. stocks after concerns on Oracle's plans for vast capital outlays on AI infrastructure drove a broad retreat from risky assets. Case in point, we've got Oracle now down by 10.1%. 10-year at 4.13% with a 2-year currently yielding 3.52%. Gold is up $47 the ounce, up 1.1%. West Texas Intermediate crude down 1.1%, $57.79 a barrel on WTI. Bitcoin 91,383. Bitcoin right now down by just about 1.1%. Eli Lilly shares up 1.9%. A next-generation next-generation obesity shot from Lilly help patients lose almost a quarter of their body weight, potentially making the experimental drug the most potent weight loss medicine yet. Again, Lilly up by 1.9%, rival Novo Nordisk up today by 2.2%. Recapping, Bitcoin down 1.1%, your 10-year 4.13%, the S&P best level of the day, trading at a record right now. We've got the S&P up by 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Can I just say, our next guest walks into the studio and we just get happy, don't we?
You say the same thing about me, right?
Yeah, I do.
Okay, just making sure.
Come on,
we have favorites, but I don't want to make. I want to make sure she's not
favorite.
Too much of your favorite.
You know you're a favorite.
Go ahead.
But speaking of guests that we love to have walk in, we do love when Lauren Goodwin walks in. She's Economist, Chief Market Strategist at New York Life Investments. What I love is that she can look at the economic metrics. She can look at the market metrics. She ties it all together, and she's here in studio. So good to have you here. How are you?
I'm great. It makes me happy to be here too. Thank you for having me.
We're all happy. It's so good. I think we're all happy that we're getting to the end of this year, which has been a wild one. And we just had our last Fed meeting of the year. Did it play out as you expected?
Yes, with a important exception, which is I just really was not expecting Chair Powell to say, we've reached a range of neutral estimates, so your guess is as good as mine. And I think that's super reasonable.
Yeah.
I mean,
it's like Jay Powell gets real, right?
Yeah, and it's in many ways, it isn't that what he said is unreasonable or super surprising or weird, or there's nothing like that, but the willingness to just open that conversation around, okay, we are in this range of estimates for the neutral rate is so important, because the quibbles that myself and my team have had with the market pricing of the Fed funds rate recently, looking ahead to 2026 has been really, it's on the margin. It's like, look, if we expect pretty good growth and sticky-ish, but nothing problematic on the inflation front, then like, if I say 1 or 2 more cuts and you say 2 or 3, like, is that really the difference maker? Probably not. Mm-hmm. But opening this conversation about like, okay, we're in the range of neutral does raise what I think is a really important question, which is as rates move lower, if we get to that 3-ish% range where it's more or less the lower bound of what most people think could be neutral.
For the 10, you're talking
for the Fed funds rate, then that's when I think we start to see the market say, no more. And actually that Fed cuts become a problem for the long end. How
do the markets say no more?
By the 10-year moving higher. Essentially a curve steepening.
Okay.
That is such a good question. In the sort of 410, 420 range that we've been, I think if as we move below 3, we get 10 or 20 basis points pretty quickly. And if the Fed is not sort of signaling, let's say, any cuts beyond that being on the hawkish side, then we could actually go higher.
So this is something we talked about with Katy Kaminski of AlphaSimplex, like trying to get an idea of what's the upper range. Like we have quite a range in terms of movements that we've seen, I feel like over the last year or so. So 5%?
I think,
or is that extreme?
I think that would be pretty bad news. I think it's not extreme in the sense that if I look at the economic backdrop of strong growth, a pretty heavy deficit, and still pretty supportive fiscal backdrop next year, and a geopolitical backdrop that's very uncertain. Like I can come up with 10 or 15 ways that we could get to 5%, but that's not really the scenario I'm talking about. And the reason is, I think that regardless of who sits in the Fed chair seat next year or second half of next year, they don't want that. The president doesn't want that. And so I'm actually not as worried about Fed independence as maybe I would otherwise be as a macro person, because I just think the market's gonna matter.
So
Agreed.
Something that I've been thinking about is if you weren't paying attention to any of the data or alternative data that we've gotten over the last 3 months, you had been taking a long nap, for example.
Oh, that sounds great.
You woke up just to see the press conference yesterday. What was the impression, and what is the impression of the economy that you got from Jay Powell?
Everything's fine. Nothing to see here. And I gotta be honest with you.
He sounded more optimistic than I thought.
Well, you said We keep seeing people letting workers go.
I hear anecdotes about this low hire, low fire environment, and people not getting headhunted at all, and like that's slowing down so much.
College graduates not getting jobs. So we're trying to kind of square that.
And it seemed like he was like, everything's kind of fine.
So here's the thing. I want to come back to the college graduates and the low fire, no hire, because I think it's really, really important. And we have been in a soft patch. I believe that we have been in a soft patch this quarter, not helped by the government shutdown, but we've been in a soft patch.
Right.
When you have earnings growth like we have seen, you cannot have a massive wave of layoffs. You could with sort of the technological developments and AI, et cetera, but that's not what's happening right now. And I don't think that's what's going to happen in 2026 either. It is just, look, coming back then to the no hire, no fire. If the market has recovered beautifully this year, but if you're a business of any kind, you are either saying, looking at the Supreme Court decision on tariffs and sort of the business backdrop ahead, and you're saying like, things actually look pretty good, but I don't know, I'm maybe not leaning in to hire or add 10 people to my team. Or you're saying, things look pretty good, but maybe I'll wait to see what happens in the first half of the year before hiring, because this AI thing, maybe we get some synergies. Mm-hmm. So I don't think it's what I'm not seeing from the labor market is like a big bearish concern. I'm seeing a wait and see. Yeah. And that's a backdrop where if we see, and I do expect that we will, the benefits of the One Big Beautiful Bill Act for both businesses and consumers pulling us out of this soft patch in the first half, that's probably not a super negative labor market backdrop.
But is it inflationary?
I think so.
Yeah,
I think so.
How badly, or is it manageable? Does it mess up the Fed and its strategy here?
So based on what I heard yesterday, I think our base case is actually pretty aligned with the Fed's, which is so boring. You love to have real fights.
You're in good company, though.
But I think look, inflation's gone nowhere this year. We've been sitting around 3% for 12 months.
Yeah.
And the answer to your question is, I don't actually expect the inflationary backdrop to be incredibly problematic, but we saw these sort of shadow dissents yesterday that are suggesting, look, if things go pretty well next year, that is a potential staying where we are, or maybe even seeing a hike by the end of next year for the Fed. That's a good economy. That's a reasonable backdrop.
Right. It's responsible.
It's
like
responsible.
In terms of what the Fed or certain members of the Fed being concerned, right?
Exactly. Now, if you look at, and we did a deep dive on this, I guess a year ago, but if you look at the instances of real double peaks in inflation in U.S. history, and we have a couple, one's after World War II, one's in the 70s, 80s, there's some ingredients that they have, and all of them are possible in 2026. So one of the ingredients you have is sort of
just got about 35 seconds.
Double dip in goods and labor supply-demand imbalance. Tariffs could be providing that for inflation. We don't know. You have a super accommodative fiscal policy and artificially low Fed funds rate. Mm-hmm. Those are not worrisome conditions right now, but that's an outside risk, but the conditions are there.
This was fun.
It's great to see you.
Good to see you. If we don't see you before the end of the year, Happy New Year. And we will certainly see you in the new year. Lauren Goodwin, economist and chief market strategist at New York Life Investments, joining us right here in studio. Hey, folks, stocks holding near their highs of this session. When we come back, a check on trading and stocks on the move. This is Bloomberg Businessweek Daily.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, you are listening to Bloomberg Businessweek Daily. You're also watching us, Carol Massar, along with Tim Stenovec. It's been like a crazy Thursday.
Is it only Thursday?
Friday's just around the corner. We're hovering near our highs of the session. S&P 500 just up about 14 points, but well off its worst levels of the session when it was actually in the red. Dow, if you care, it's up about 1.4%. And the NASDAQ 100 still in negative territory, down about 0.4%, but it's definitely off its worst levels of the session.
So that's where we are on this December 11th, just a little over an hour from the close of equity trading on this Thursday. I'm Tim Stenovec, along with Carol Massar. Let's take a look at some stocks on the move today. With us is Bloomberg News cross-asset reporter Isabelle Lee. Isabelle, a lot of stocks moving today. One to the upside, Eli Lilly.
We have to talk about Eli Lilly. So the stock was higher by around 3%. Now it's pared back some of those gains, but still up by 1.5%. So investors are cheering a next generation obesity shot that helps patients lose as much as 23% of their body weight.
It's a lot.
I know, I was computing in my head, and I was like, that is a lot.
It's a lot.
No matter how much you weigh, that is a lot.
Yeah.
And this could potentially make the experimental drug the most potent weight loss medicine yet. So patients on the highest dose of the drug lost nearly a quarter of the weight in 68 weeks, so that's more than a year, but still. And the study participants experienced a 62% reduction in knee pain. And I was talking to the author of this story, Madison Muller, and I was telling her that, when you think about weight loss, people usually associate it with superficiality or looks, but it actually really helps people who have medical problems, and it can help you with your lifestyle improvement and just overall make you healthier. And why is this a big deal? Because the obesity market is expected to hit around $100 billion by 2030, which is massive.
I mean, listen, we have just talked about how overweight the American population is, and diabetes, how many Americans are either pre-diabetic or diabetic. It's a large portion. I want to say like 40 or 50% of our population easily. And if you think about what this can do in terms of, for some people who are having a hard time losing weight, who are diabetic, this can be a game changer. We kid with Madison all the time, like, is this the drug that's going to fix all that ails us? But it kind of gets down to that point that being overweight is, I know it's hard for some people in terms of weight management, but it is a much healthier thing to be, not be overweight.
Yes, the ticker is LLY, and the company's shot, the Zepbound, is already the most popular. But of course, Lilly is trying to develop and racing to develop drugs that are more effective, and the competition there is also intense.
I was looking at,
What are you looking at?
Around 38 million Americans have diabetes, roughly 1 in 10. So it's not maybe half.
Look up. Good job, Carol. But that's a lot of
silly little thing called Google AI.
Not ChatGPT.
No, I didn't get there. But it says over 1.3 billion. This is a Bloomberg story. Actually, this is a couple of years ago. Over 1.3 billion globally will have diabetes by 2050. Wow. So that's a lot of folks. All right, so Eli Lilly, a gainer.
What about Gemini Space Station, the fintech firm?
This is a big gainer, up by 25%. So Gemini, when you think about it, with your crypto show, why? Oh, nothing.
Because I have to do gainers, but I should have done this one. Anyway, go ahead.
It's not too bad, Carol.
You should do it, Carol. It's 25%.
And you get to say Gemini Space Station.
Exactly. So Tim, who hosts the crypto show, you would know that when you hear Gemini, you think it's like a crypto exchange. But then, no, of course, they're trying to also muscle their way into the fast-moving field of prediction markets. So
I knew you were going to say that.
Their application for a derivative exchange was approved by the CFTC. So now they're clearly expanding, and according to their website, it will allow soon existing U.S. customers to trade events contract. And this is interesting because increasingly crypto-native firms like Polymarket have been straddling digital assets and prediction markets, but now a lot are trying to do both. And many firms have really expressed interest in this.
I want to know when they're going to build the space station.
Gemini Space Station, ticker GEMI.
Why are they Gemini Space Station?
I still think of it as being called Gemini, but the official name is Gemini Space Station.
I know.
It's the Winklevoss.
Winklevoss twins, they're
that's
co-founders.
them.
Gemini.
Yeah, right.
Some people say
Gemini.
Winklevi because it's the plural of Winklevoss.
Winklevi.
Those who didn't get
Can
it.
I just say 42% of the float is short on this puppy?
Oh.
So that's a little bit of negative sentiment.
Yes.
Just going to put that out there.
Yes.
Even though it's flying high today. Oracle not flying high today.
Not flying high, down by 10%. That's, I think, the most since at least January, erasing more than $100 billion in market value. And at one point was on track to close with its steepest one-day drop since 2001.
It's a long time.
That's 24 years ago. So again, this comes after, of course, the company said that its capital expenditure is about to reach $50 billion by the end of the fiscal year, ending in May 2026. Annual revenue will be around $67 billion. So this is interesting because, again, it's like AI hopes and dreams. I've talked to some analysts and they were like, Oracle gave investors everything they want on paper. But of course, you still hope for more and more. And cloud sales increased, as did revenue, but both fell short of estimates. And the latest report just really makes you think of the reversal fortunes of Oracle, which earlier this year was just having a blistering rally. Remember, its co-founder, Larry Ellison, was at one point the richest man on earth, richer than Elon Musk.
Yeah.
But now we're seeing shares down by 10%. Ticker is ORCL.
Really good list of stocks, and I highly recommend everybody check out our conversation with Bloomberg Intelligence Senior Technology Credit Analyst Robert Schiffman earlier this hour, because he gets into the credit story. He's not so worried. I felt like.
No, he thinks it's kind of being overdone.
Yeah, exactly. All right. Thank you so much, Isabelle Lee, Arch Stock Movers Podcast. Biggest winners and losers in the stock market. Find it on Apple, Spotify, or anywhere you get your podcast.
Coming up next on Bloomberg Businessweek Daily, machine learning and AI to sort through stock. BlackRock's crew of quant PhDs are on track for a record year.